I think I will now pass the floor to our speakers for any opening remarks and business update before we kick off, I think, the most interesting part of our call today, Q&A session. Thanks very much. Alexander, Ekaterina, the floor is yours. Please go ahead.
Thank you, Arthur, and welcome everybody to this call. It's a great opportunity always to talk to the investors and our shareholders. We don't have any particular structure how to kick it off, and therefore I'll rumble a bit about where we stand and how we see evolution of our strategy, and then Ekaterina will take you through a few key numbers which we saw in the first quarter and now, and then we will be happy, of course, to address the questions. So let's kick off. I think that the best way to start at this stage describing where we are, and I assume that everybody knows somewhat about M.Video, what we do and what's our size roughly. I think that the most important thing is to articulate again, what are we trying to do strategically? Because a lot of things are happening on the market and everybody is running very, very fast, and it makes sense now and then to get sort of on the balcony and to look at what we're trying to do. So if I would try to summarize our strategy, I would say as follows. What we're trying to do now is to scale up our technology, One Retail, and scale it up both inside of our primary network, M.Video, brand where it's been launched, and it's been in use since 2016-17, and it came to scale last year, and it shows great results. So it's a significant part of our business already, and we're trying to convert as many transactions as possible onto that technological platform, and we see that it's working. We definitely see very fast growth of our customers and number of transactions which are happening there. And we see, of course, financial outcome of what we do. The second part of this scaling up will be to apply that technology to Eldorado. The problem is that our underlying technological platforms, i.e. the systems which we use for warehouse management and onwards, to how we plan and what we do in the stores, how we settle the transactions in the stores, they're different between Eldorado and M.Video. So we've integrated the back end, but the front end remained quite distinct actually. The technological platforms for the websites, for the applications, all of that was done on a different technological stack. So that decision, which we announced today about combining management of both brands under the single umbrella, which we call One Retail, tellingly, is about accelerating and harmonizing exactly that process. So we want to move much faster in Eldorado as well on one side, to continue to roll out our One Retail solution into the stores of Eldorado. But also, we want to avoid unnecessary duplication of effort and maintaining legacy systems in Eldorado, while we can actually reconfigure it much faster and get the fruits of One Retail earlier, avoiding that lengthy maintenance of the legacy systems. So in a nutshell, that's what it is. It's not that we're going to abandon Eldorado and not that we're going to shut it down. We will continue to go with two brands, and we will look for opportunities actually to make it even more efficient by harmonizing how we run promo activities between the two brands, how we leverage our communication. So in that sense, instead of having two brands which are competing independently on the market, we're bringing them into a fold and they start competing within the portfolio. And that portfolio will be managed by respective brand managers. And we're also hoping to extract some efficiencies in how we combine the structures and eliminating redundancies in the structures, mainly on the marketing side, but to some extent in the management of the retail network side. So that's in the essence of about the essence of today's announcement. Coming back to our strategy, that to tell you where we are in our physical rollout, we continue with our new format, or relatively new format, Eldorado 250. It shows very good results. Essentially, all of the stores which we're opening are exceeding our expectations in terms of return we earn on the investment, because we're going with much cheaper way of opening the stores, and also we're going into the cities where we traditionally wouldn't dare to go with formats of M.Video, which are much more expensive and more demanding in that sense. So that let's call it guerrilla war is quite effective for us, and we continue in that direction. We also mentioned that strategically we will be reconfiguring our logistics. We keep on working on this. I cannot give you any specific updates. I'm just saying that it is very high up on the agenda of the management. And for me, it became clear that looking forward, the quality of logistics solution and fulfillment solutions which companies in retail and e-com will be offering will be the battleground. And therefore, we're putting now a lot of management attention and a lot of thinking into how we will reconfigure it. I think that when we come back to you with our reports on the first half of 2021, we will give you an update on where we stand strategically with our logistics evolution. One thing I can promise, and that's what we see from all our modeling, that our approach when we focus on fulfillment from the stores indicates that we can deliver superior service quality compared to the marketplaces, while not increasing significantly our logistics cost. It was actually quite surprising to me as well. We're talking very, very minor increases, and I remember Katya likes to remind us about that number, that our current logistics cost only 3% of our turnover, and we're talking about very minor increase to that number. From the traffic standpoint, from the not traffic, but rather our focus on moving away from anonymous transactions to working and building our client base, our customer base, we are moving well. This is our primary target. I remind you that we had last year 18.8 million active customers on the LTM basis. And our objective, which we put ourselves for the next 5 years, is to move this number to 25 million. And that's supposed, with all the benefits of operating on one retail, supposed to give us improvement in frequency and check, and supposed to give us close to 1 trillion in retail sales. And we're moving well, and we're well on target. We keep on recruiting and actually doing that without sacrificing anything, or we don't see any deterioration of the quality of the transactions on the platform. And we still see kind of our average check hovering way above 11,000 rubles for those who are on the platform, as well as frequency over 3. So all our parameters which we indicated, they're kind of intact. And That's probably it on the key strategic parameters with which we're moving. And Katya, over to you.
Yes, hello everyone. I'm happy to talk to you, and we are always ready to answer all your questions. I think I will be really brief. I will just, in terms of the reminder, show you the figures of how we closed the year last year. I think it was one of the, in spite of COVID circumstances, it was one of the most successful years of M.Video. Another successful year, if I can put it like that. We delivered a very good growth rate, plus 15% GMV growth. But what's more remarkable, we grew in online sales more than 100%. You can see the total online sales growth was 109%. And what's more important in terms of the quality of online sales, one of our strategic targets and part of the new strategies that we are looking for the growth in mobile platform. And you can see that sales in the mobile platform last year grew 152%, which is absolutely remarkable. And the share of online at the end of the year was 60%. I suggest that we switch right away to the first quarter results. If we're talking about the first quarter figures, you can see that we still, in terms of the growth rates, they remain double digit. So you can see that the first quarter GMV is plus 14%. In terms of total online sales, we do not experience 109 again, but the total online sales are growing 63% year on year. But the share of online sales is more than 60%, is coming closer to the number of 70%. It is actually 67%. We are targeting the number to grow more than 70%. It is nice to point out here that the sales in mobile platform show the growth of 90%, which is absolutely well expected. That's what we are targeting. That was part of our budget and our business plan. And as Alexander mentioned, we are not only trying to make sure that our clients are using our mobile platform. The idea is that we are actively growing the number of identified customers. And it's important that we are not only growing the number of identified customers, we are in the group of identified customers, we're growing the number of one retail customers. And the share of one retail customers, the ones that are using our mobile platform, is currently 58%. Why it's important for us, I think the next slide shows you. Timur, if you can switch to the next slide, next one. You can see that the quality of the transactions, as soon as the customer is becoming one retail or using our mobile platform, is much better. You can see that the average check of the one retail customer is much higher than the ones that are not using the mobile platform. It's more than 11,000 rubles, when the total average check is 9.3. We experience also the growth of average ticket for one retail customers. So generally speaking, if we're talking about first quarter, it was one of the other successful quarters of the group. We were also, we do not disclose those numbers, but I can share this information with you. We were very good in managing costs as usual. We delivered a very good bottom line performance, and generally speaking, the first quarter was a very good one.
All right, I think it's time for us to take your questions.
Alexander, Ekaterina, thanks so much for this pretty comprehensive update. Yeah, I think we are ready to proceed with the Q&A session.
Dear colleagues, in order to ask a question, you can raise your hand and we will unmute you. Or you can also place your questions in the Q&A session. Please type them and we will read it out loud for you and answer.
I think I could actually take advantage of the small pause before our clients hopefully become a little bit more active. Alexander, Ekaterina, I can't help asking about the variable that is, I think, the hardest one in terms of modeling, in terms of forecasting. This is your gross margin. We remember that there were some product shortages in place towards the end of last year, which somewhat distorted your purchasing. What do you see in the market from this perspective? Do you see any shortages that could affect your purchasing during the first half of this year? What are other trends and factors that could define gross margin evolution in Q2, given that Q1 was probably pretty good? And finally, what are the risks that you potentially see for gross margin into the second half of the year? And what factors we should be watching most of all?
Thank you. Very complex question, and there are too many moving parts to give any more or less even definitive answers here. The way we see it at the moment, that on the supply side, apart from relatively few categories like gaming consoles and so on, we don't see massive shortages. I think that we are in stock. With one, of course, very notable exception, that we lacking balanced supply in the telecom sector. The telecom sector been affected both by the chip shortages, but as well by sanctions against Huawei, and that kind of broke the balance of in composition of the phones. So that shifted the picture, and in the second half we might see a shift back. At least sort of we're getting information that it might be either as a workaround or direct kind of permission for Huawei to start using Android system again, and so that would restore the balance in that sector. But from the margin standpoint, I would say that the supply side now is less of a factor. What is a factor, on the other hand, is of course intensified competition on the price level. And we see it coming from all the directions, virtually across the categories. And we see more and more entrants which are chipping away at the market. And we have to, of course, defend our turf. So some of our growth, which is very strong at the moment, so we can say that it's north of what we're showing for the first quarter. I'll just remind you that the first quarter number has been affected by 1 month, that we had exceptional March last year, where the growth was close to 40% because of ruble devaluation, which drove excessive demand. And year-on-year comparison of March 21 versus March 20 brought the overall growth of the quarter down. But first 2 months, the growth was over 20%, and that's what is kind of a more normal, what we see now. So that's the growth rates we're talking about. And with that growth, we see quite intensive price competition, and that's what we're trying to stem on one side. Sort of, we're trying to be good behavior and not to engage into very deep promotions and so on. And on the other side, we have to meet at least our major competitors, their price moves, and that's puts a pressure. I wouldn't say that it is something of extraordinary yet, which would require us to reconsider our parameters, which we set strategically, EBITDA 5 to 7, and we're trying to steer the company on that parameter. So we're well within that corridor, and we don't see so far any suggestions that it will be significantly off the median point on this year.
Which means 6%.
Median point, yes. As you can see, I am very reluctant to guide because I don't see any benefit for the company in that. But in principle, of course, that's how we think. We're trying to kind of steer our cost base, and if we don't get enough in the gross margin, then we're looking for opportunities to compensate in the operating cost. And as Katya suggested, we're doing a fantastic job there. The guys are really managing cost extremely well. So I think that between the two, adjusting the intensity of our promos and managing the cost below, sort of in between gross margin and EBITDA, we will land where we want to land.
Right, understood. Thanks so much for this. We started to get questions from our participants. Actually, there are two very similar questions about one retail concept. Could you please explain once again your one retail concept? And another similar question with regards to one retail: why does ticket size rise so much when a customer uses the app?
Okay. The One Retail is effectively a technological stack which consists of two platforms. One is web and one is mobile. Mobile in its turn breaks into two applications. One application is standard consumer application, which other players also have. But what's more unique for us, it's an application which helps a sales rep in the store to interact with the customer, and that impacts dramatically the way customer structures its journey and what's at the end of that journey. Why are we talking a lot about it? Because essentially it's a advanced version of omnichannel on steroids with this type of communication. Our customers, as the research shows, 3/4 of them involve in their journey, which usually lasts about 2 weeks when they make a purchase of that scale, like what we sell. And it involves multiple touch points. They start usually online, then they go offline, they see the product, they make the decision, then they go back, they probably do more research, and then they make a transaction, make a purchase. To identify the customer when it's online, relatively easy, and many people know how to do it. But to identify the customer in the store, when they're actually making very often at the crucial junction, when they make a decision, when they're comparing the product, when they actually go for touch and feel, or hugging the fridges or whatever they do, that's very, very challenging. And that's where this app helps, because it allows our sales consultant immediately invoke all the power of history of search, history of purchase, what's this person is after, and prescriptive and predictive analytics here start working in full steam. So the customer gets on one side, help from the sales consultant to solve the problem, but on the other side, the problem is being solved in the most efficient way for us. For example, if the customer looks for a particular TV set, TV type, and we don't have it in stock, we can easily, or relatively easy, steer it towards a little bit more premium option, and also offer personal pricing, which would engage all of the bonus points accumulated or bonus rubles accumulated on the account, and therefore make the transaction much more appealing, and perception of the lower price point makes it much more engaging for the customer to acquire. So typical question which follows is that why guys you considering as online sales? The answer to that is, imagine a normal, a fairly regular customer journey that somebody is buying a TV. They start a search online, they compare prices, they compare technical characteristics, whatever, and they narrow their choice down to 2 or 3 sets. They go to the store to see how they look, sort of the true color reproduction, and ask the opinion. So they get the advice, and along with that advice, they get the suggestion, more affirmative suggestion that this is the best solution for you, plus all the attachments which come with that. So cross-sell, upsell works in full swing here, which brings the check up. Then that person might go home and still feeling uncomfortable about the transaction and needing more time to make the decision. Don't forget that our average check of 11,000 rubles compares to 30,000 average monthly salary. So for many, many households, what they do is a massively important purchase. And of course, it's a highly engaged and involved purchase, and it takes time to make a decision. So the person can go home, and our sales agent can send the basket, which been formed in the application, to that person with the suggestion, for example, to add this cable or this whatever hanging attachments and subscriptions or whatever, and offer additional stimuli, which would be at his disposal. And then person decides, okay, I close the transaction, they click the button, and they go back to the store to pick it up and to pay at the point of picking up the TV set. That gives us another opportunity to interact with that customer and follow up on the transaction, and maybe to increase the attachment to that purchase, because they might have forgotten something, or they might as well look at, now they bought the TV set, they want to look at the sound system which is attached to it, and you engage into another set of discussions. So that's the power of our One Retail platform. So essentially, it's independent of where you are and how you interact. It's an uninterrupted journey, and it's at any point when you touch our brand, you get support and the power of our analytical platforms.
Thanks for this. And just a very quick follow-up from our participant with regards to this application of your salespersons. Does it alert the salesperson when a customer enters the store?
We're launching this, and within a month it will be available.
It's actually already on. I've tried it. I don't know. Maybe it's a kind of for the CEO version of the app, but it's definitely on. So there is a button. Simply you open your app, and there is a button. I'm in store, and the app and it informs available sales assistant to come and help you. It might be that we're trying and piloting it on first 150 stores. That was the plan, but it will be soon in every store. And that works in 2 types. So I am here to pick up which I ordered online, or I'm here to make a purchase and I need a consultant.
Okay, so a customer needs to press the button to notify the salesperson that he's coming.
Yes. The reason why we're doing it, well, I mean, would be great, of course, but it's a privacy issue. If we would do it automatically, identify the customer and so on, but we're restricted by the privacy issue, how much data we can collect without consent of the customer. Hence, we offer customers to open the app and press the button. In general, what we're trying to incentivize the customers to use app in store as much as possible. And what we're also piloting, it's a personal price where there is no price tag on the shelf. There is a QR code, and so you point your camera on that. I mean, there is a list price probably next to it, but if you point on the QR code, you get your personal price on that specific item, and your price will be different from mine. And that kind of calculated in a complex modeling way, incorporating your preferences, your readiness, and as well as what sort of bonus rubles and other buying power you've accumulated with us.
Thank you. I think we have a couple of live questions from our participants. Anya, please let our clients ask a question.
Hello, yeah, I see that Olivia Gregg is going to ask a question. Olivia, please.
Hello, thank you very much for the call. It's been very interesting. I have a question, please, about your LTI program for management. How is it structured? What are your main KPIs and triggers? And what is the calculation formula for it?
Olivia, I have to disappoint you at this point in time that the current program which been in place, it's been structured in such a way that it's been geared towards liquidity event, and therefore stimulating management to prepare the company for the liquidity event, SPO, which took place. So now we are working and we will do it in 4 or 5 weeks on presenting the new LTI program to the board, and we will be communicating about it accordingly. I think that it wouldn't be probably far-fetching for me to say that the concept there would be TCR and TSR, sorry, and how we will attach it. So what will be at the grant, what will be at the vesting is still in discussion. But we're also trying to broaden it significantly, because now it's only essentially top management been involved in LTI. And now when we're competing actively with likes of Ozon and Yandex, who are using their LTI programs to much broader population, we have to start using this tool as well. So that's why it's a two things, sort of how we compose it in order to align as much as possible interest of management and the shareholders. And the other one is how to make it that we could push it deeper into the organization. But it's in the cooking, I would say.
Perfect. Thank you very much.
Thank you. We also have one more question. Vitaly, please go ahead.
Hi, thanks a lot for the call today. So can you please elaborate on the competitive landscape? So do you compete primarily with the digital or brick and mortar kind of retailers? Who is the most successful competitor and why? And what would you say is your major competitive advantage over your peers? Thank you.
Okay, multifaceted question here. So the competitive, I mean, the complexity of the question, if you would ask this question probably a year ago, right? I mean, the answer would be straightforward. Right now, things are moving so fast, and the data which we're receiving from the market is obviously lagging compared to what we see. But nevertheless, let me try to give you my perspective on this. So we have two distinct sets of competitors. We have traditional competitors, and they consist of somebody who is very similar to us, which is DNS, and it's considered to be our primary traditional competitor. For those who don't know, DNS is, yes, indeed, very similar network, which have been originated as a regional network in Vladivostok and grew from east-west and now present very broadly and deeply in the country. The other player is CityLink, which operates on a distinctly different format from us, but still relying to a large extent on physical presence. Then we have a set of operators who are selling and selling mainly mobile phones. So telecom is a very important segment because it's very fast growing but extremely low margins. So there it's probably the most intense battle. And telecom operator is also supplemented by one large network, Svyznoy, which is specialized on phone sales. So it's a car phone, if you wish, analogy from the UK market. And we have few smaller regional players. So that's the traditional set. And now we have also a set of marketplaces, which consist of 4 players and the fifth incoming. Fifth incoming would be Sber, whom we are in partnership because we are minority shareholder with Goods, which is a marketplace. And they now start actively promoting their services as well. So we have 5 marketplaces, and all of them naturally trying to compete in our category. So with that landscape, whom do we see as a primary competitor? I believe that marketplaces currently are relatively small, and of course they're important and they will be growing, but currently their market share is about 5%, 5+, cumulative market share. In our projections forward, how we see the market? We see the market that at the moment it's 40% online, 60% offline, and in the space of 5 years it will flip and it will be 70-30. And marketplaces will increase their market share to 10, 12, maybe 15%. That's what we expect to see in our category, the share of marketplaces. As I said, our thinking is based on examples of Fnac.rt, Best Buy, and so on. So the physical or players with the physical presence will retain their foothold because the category is of high engagement and will require, or the customers do require, ability to see and touch and feel the product. So that's marketplaces. In space of 5 years, we see that them doubling their business in our category, but still remaining with the market share of 10-12%. As far as the traditional players are concerned, they pursue very different strategies. DNS during last, let's say that currently DNS has double that of number of stores compared to us. We operate on 1,100 and they operate on 2,100 stores, and they keep on opening their stores. When we compare store performance and the density of sales and so on, they are significantly lagging, and therefore they're taking actually, they're making a bet that by increasing dramatically the presence across the country, that would be sufficient for them to win the market share, and that business model will be sustainable. I have my doubts about that, and I think that we will see probably them gaining market share this year still, because it's a sheer effect of opening. During last 2 years, they opened 700 stores. Third of their stores been opened during last 2 years. And of course, it will have spillover effect into this year, but they will run out of country. They will run out of places where to open the stores. And also the traffic natural traffic into the stores is probably going to decline. We maintain our traffic because we have a lot of pickup coming from our online sales, originated effectively through our online sales. But the traffic which walks through the door to pick something from the shelf and that type of transactions is going down. Hence, now we're effectively making a bet that our strategy in investing in technology and identifying the customers and building a link with the customer and working with the loyal and active customer base will yield us much better transaction quality. And that strategy is opposed to or juxtaposed to the strategy of expanding the stores and we come and we put the stores, they will come. I don't think that will last for long. So that's the two differences. There is a third player, which I respect a lot, CityLink, and that's the one we're watching very carefully. They're significantly smaller than us, and the format which they use, as sort of I'm more familiar with Swedish environment. Those of you who know that market, it's a Webhallen, for example, is exactly that format, where you effectively you don't have a showroom. You have a couple of terminals and you have a massive storage at the back of the store, and effectively it becomes a pickup point. So, and they vary their stores by the size of the storage and number of SKUs they're carrying. But essentially, it's a model which is a kind of in between the pickup and the store. So it's an interesting format. I think that we will be looking closely, and maybe we will pilot some of those solutions as well, because they seem to be logistically friendly and efficient. And that competitor, number 3 of us traditional competitors, is doing well. And so I think that would be the main battle actually between us. I hope that I gave you the overview of the competitive landscape.
Yeah, thanks. That's great. Thank you very much.
Thank you, Alexander. Let's get back to questions from the chat. We have, I think, one of your favorite questions about economic viability of keeping offline stores in the current environment.
Guys, why don't you take this question?
Well, I think we covered this especially when we were talking through the strategy, and we mentioned that the role of our stores is absolutely different now versus the times when we were considered as a traditional retailer or omni-channel retailer. We are saying that the stores actually play a significant role in terms of managing our logistics infrastructure. 50% of our stock is located in the store. And that allows us actually to be really close to our customers and to provide value proposition to our customers, which is very difficult to match. When we're talking about our competitive advantage, we are absolutely, kind of assured that that type of footprint across the country allows us to provide the proposition that is really difficult to match. We are able to deliver products within 15 minutes delivery time to our customers, and more than 80% of our online orders are available for our customers the same day. And that, that level of service will continue to be upgraded in the future. We already invested around 150 billion of rubles to build that type of infrastructure. And as Alexander mentioned, one of my favorite numbers is that all our total logistics costs comprise only 3%. And if you compare to marketplaces, in their case, it's 30%. So We do not compare offline economics with online economics because it doesn't correspond to the concept of one retail. In one retail concept, there is, the first word is one. And the experience is really seamless now. Alexander mentioned that in our mobile platform, we are providing the environment that allows us to have single basket between two mobile apps, and we have that dialogue between both mobile apps, mobile app that our salespeople are using and mobile app that our customers are using, and that digital environment is absolutely seamless. We do not try to allocate any costs to online or to offline. We consider those channels working the same target, the same goal, and we use all our offline infrastructure in order to get all the online growth.
I only want to add to this is that another kind of very abused word nowadays is agile. Right. I mean, and in that sense, I want to apply the agility not to how we build our product teams and how we develop our software, which we do, but more that the company needs to be agile on multiple fronts. And one of them, how we deal with the stores. We will introduce, and we analyze the stores all the time, but we'll introduce deeper inspection in terms of how we balance the sales in the store versus the role store plays online and pick up. And we might rebalance the front and back side of the stores. We might convert some of the stores into the dark stores. We might actually introduce the dark stores as an independent element in our logistics network. And that's the work which is currently ongoing. How can we, in a most optimal way, to secure stock, which we currently have in our stores, as close as possible to our customers, which would allow us to decrease the cost of the last mile, and at the same time to be extremely competitive on the timing and the accuracy of service which we provide.
Thanks. That's interesting. Another question from the chat room. Do you know any other consumer electronics retailers around the world that are using apps similar to your One Retail?
Not really. I mean, it's definitely not in our category. We saw some attempts in other categories to do something like that, to link sort of the global storage, if you wish, and sort of to allow endless shelf to be at the disposal of the salesperson. And we saw something of that kind, linking the profile of the customer to sales app in India, which was piloted there, but we couldn't find direct comparison.
Mm-hmm. A small follow-up question with regards to your pilot project alerting sales consultants about the arrival of a new customer, of a customer to the store. How do you know who these customers are when they come in the store and connect to their online searches?
As soon as the customer gets into a dialogue with the salesperson, our sales consultant, they ask them to identify themselves and punch in the phone number. So that's the immediate kind of what works now. And then they have the full story, right? Sort of they basically log in. But we work very hard to incentivize them to do that. And as soon as they, for example, open their app and they press the button, I am in store, that already can be sent with the ID of the customer. And therefore, when consultant comes who receives this call, comes to greet the customer, they already know whom they're talking to.
Right. Do we have any other questions? I don't see any new ones in the chat room. Do we have any live questions?
No, not yet. Dear colleagues, just to remind you, in order to ask a question, you can put them in the Q&A session or raise your hand and we will unmute you.
I think in the meantime, it would be interesting for me at least to see about projected impact of this sort of corporate change that you announced today. So basically, this one retail business unit will combine management functions of both brands while keeping those brands separate with the differentiated market positioning. Obviously, I think you would expect to see some cost synergies once this project is implemented. Any comments with regards to the potential timeline of those synergies and the magnitude of those synergies in terms of your OpEx?
I prefer not to talk about it at this stage. They're not going to be huge because currently we're merging only the top. Sort of the biggest synergies would be if we start merging the regional management structures and so on of the stores. Those we prefer not to disturb at the moment. And we will have at length discussion during the summer where we crystallize the evolution path for the brands and what sort of roles Eldorado might be playing going forward, and it might veer off of the current consumer electronics only, two brands steaming alongside of each other. And so when we answer that question, then we can move deeper into the organization and start extracting the synergies. Currently, the main purpose was not to extract cost savings. It was to speed up the decision-making process and harmonize the decisions in order not make the organization to agonize over differences in the promo plans between the two brands and how they can hurt each other and so on, because they've been competing with each other. So that's the primary thing. And also we're definitely going to save on the CapEx, and we will redeploy that CapEx more effectively.
Right. Thank you. We got another question. I think another favorite of yours. Any plans for fresh capital raising or to do an SPO?
And you know my answer, right? I mean, it's I personally believe that the more is in free float, the better. And I'm preaching to our main shareholder that, and but it's up to them to decide if and when to do another transaction. So it's a not question to the management, it's more question to the shareholder.
Thank you. Anya, can you see any other questions that were unanswered at this stage?
No, this time no.
Yeah, I think we still have a couple of minutes to ask some questions. I mean, honestly, my question would be with regards to sales. You probably saw that your non-food retail competitor, not the direct competitor, but at least competitor in the capital markets, Jet reported, I think, around 57% growth for the top line for April and May. Obviously, we're looking for very significant acceleration of revenue growth for M.Video as well, given a very low base of lockdowns of last year. Considering expected normalization of revenue growth in June, what sort of revenue growth rates might we be talking about for the second quarter average?
That would be kind of incorrect for us to start divulging this information, but I think what Detskimir shows is a ballpark kind of what retailers will see because the shop's been closed between sort of mid-April or early April and mid-May. And so that, of course, gives you a base for that spectacular growth. I think that the underlying growth in the market is, for us, more sort of half of that, as I said, that if we take as a guidance our growth rates in January, February, they probably will be more representative. However, said that, they absolutely were contrary to our expectations. They're way, way higher than what we expected growth rates to be. We were surprised by that. And the whole entire market was surprised by that. So it's hard for me to say how long it's going to last. Some vendors take more pessimistic view for the second half, but at the moment we are kind of operating on those numbers.
And just to make sure, here we're talking about M.Video's combined M.Video Eldorado group revenue growth rates or consumer electronics market growth rates as well.
But it's roughly the same. So we are, with our market share, was not significantly changing during this last few months.
Mm-hmm. So as far as I can see, we have no more questions in the chat room. As long as Anya is silent, I assume that there are no live questions either. So yeah, I guess that was a great call. With this, I think we can conclude. Alexander, Ekaterina, again, thanks so much for taking your time and talking to us and investment community. Dear colleagues, thanks for joining this call. Yeah, I think with this, I've got nothing else to say but to wish you a very pleasant evening or day for those who are in other continents, and hope to talk to you soon this way or another. Thank you so much.
Thank you, and thank you for your great questions.
Thank you. This concludes our call. Thank you.
Thank you. Goodbye.
Thank you.